Are you missing out on one of the most powerful tax strategies available to executives without even realizing it? You might be maxing out your 401k and checking all the right boxes, but there's a good chance you're overlooking a unique opportunity to turn today's income into tomorrow's tax free wealth. And if you're over 50, the opportunity becomes even more valuable. If you're an executive at a major tech or aerospace firm, your 401k may include a critical but often ignored feature. But just having access to this feature isn't enough. Many executives miss the one step that separates smart planning from costly regret. You might be managing your 401k with discipline and intent, but if you're not taking this step, you could be undermining the very advantage this strategy is built to deliver. Quick question. Are you contributing more than the IRS pre-tax limit to your 401k? And if so, are those extra dollars being automatically converted to your Roth 401k before they generate taxable earnings? If not, you're opening the door to unnecessary taxes and failing to capture a high leverage strategy for executives who've outgrown traditional Roth options. Hi, I'm David Dunn, a CPA, wealth, and tax strategist with David Dunn Wealth and the creator of the Critical Mistakes series, my signature educational platform designed to help you navigate financial complexity and avoid critical mistakes, some costly, others irreversible. For over 30 years, I've helped technology and aerospace executives navigate the complexities of their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy. I know how overwhelming these decisions can feel, and my goal is simple: to help you take strategic action with more certainty so you can focus on your career, your family, and life beyond work. If you enjoyed this video, please consider liking and subscribing. So what is 401k critical mistake number one? It's not taking full advantage of your 401k's potential because you're missing two key steps. Number one, making after-tax contributions beyond the IRS pre-tax limit. And number two, automatically converting those contributions to a Roth 401k. This strategy only applies to future contributions, not ones you've already made. If you're wondering what to do with existing after-tax contributions, check out my video on 401k critical mistake number two. The cost of this mistake isn't always obvious, but it can be big. Let's break down the two biggest consequences. First, you miss the chance to hyperfund your 401k. Let's review the IRS pre-tax contribution limits for 2025. $23,500 if you're under age 50, $31,000 if you're 50 through 59 or 64 and older, $34,750 if you're 60 through 63. But here's what many overlook: the total 401k contribution limit, including pre-tax, after-tax, and employer contributions, is $70,000 if you're under 50, $77,500 if you're 50 through 59 or 64 and older, and $81,250 if you're 60 through 63. That means, depending on your employer's contribution, you could contribute up to $46,500 in after-tax dollars. These contributions grow tax deferred, and when paired with the Roth conversion strategy, they can become a transformative source of future tax-free income. For executives who are phased out of Roth IRA eligibility, this is one of the few remaining ways to build tax-free retirement assets. Now let's talk about the tax trap. Meet Jason, an executive at a leading tech firm. Over the years, he contributed $100,000 of after-tax dollars to his 401k. But he made one mistake. He never converted those contributions to a Roth 401k. His investments did well, growing by $200,000. Jason retires at age 60 and withdraws both the contributions and the earnings. The $100,000 contributions, he can withdraw that tax-free, but the $200,000 in growth, fully taxable as ordinary income. At a 37% tax bracket, that's a $74,000 tax bill, a hit that could have been avoided. This is the hidden cost of taxation. Without converting after-tax contributions, the growth becomes taxable, wiping out the exact benefit this strategy is designed to create. So, how do you avoid this mistake? Here's a simple 3-step approach. Step number 1, once you hit the pre-tax limit, keep going on an after-tax basis. To estimate your max, subtract your employer's contribution from $46,500. Then contribute as much as your cash flow allows. Step 2, if your plan allows it, opt into daily automatic in-plan Roth conversions. This minimizes the time earnings can build up, reducing or even eliminating the tax triggered on each conversion. Step 3, the strategy is powerful, but it's also complex. Getting it wrong can be costly. A qualified advisor can help you implement it correctly and avoid common pitfalls. Before you move forward, here are 2 quick warnings to keep in mind. Warning 1, if you already have an after-tax balance, consider transferring it to a Roth IRA and the earnings to a traditional IRA before starting daily automatic in-plan Roth conversions. That can help reduce or eliminate taxes on future conversions. Warning 2, if your plan does not allow daily automatic in-plan Roth conversions and you're doing it manually, you could trigger unwanted taxes. In that case, consider periodically transferring after-tax contributions to a Roth IRA and earnings to a traditional IRA. I cover both of these scenarios in more detail in my next video, 401k Critical Mistake Number 2, which is part of my Critical Mistakes series. You've seen how one misstep can result in a major tax hit, one that is completely preventable. Now's the time to take control. By hyperfunding your 401k using the Mega Backdoor Roth strategy, you can stop letting your 401k run on autopilot and start using it like the strategic tool it was meant to be. Want to stay connected? Subscribe to my complimentary email newsletter for insights from the Critical Mistakes series, or follow me on LinkedIn, YouTube, and Instagram. Ready to dive deeper? Schedule a complimentary 30-minute virtual meeting at daviddunn.com. If you found this helpful, please like it and subscribe, and share it with family, friends, colleagues, and coworkers.